Alright, in this video we're going to take a little bit of a detour and talk a little bit about a specific situation in which we need to do our star G entry, consolidated entry, a little bit differently. Now, before we kind of go through the change, and it's really a small change, but I want to give you kind of an idea of why we're making the change. We're going to go through a refresher of what we're talking about and why we're doing it. So there's a lot here, but at the end of the day, we're talking about one change that's going to occur when we do our star G consolidated entry. Now, what is that star G? Well, in the previous video, we talked about that star G is a debit to retained earnings and a credit to cost of goods sold. And what we're doing with that star G entry is we are recognizing the deferral in the gain of an asset transaction of an intra-entity inventory transaction. So, you know, kind of going back, what are we talking about? We're talking about a situation in which a parent sells a subsidiary goods. At the end of the year, there's some of those goods still left, and we said that unless those goods are sold to a third party, it's as if that transaction never happened. So we do a consolidated entry G to defer the gains that the parent would have booked for selling that inventory to the subsidiary. And then after the new year, we would assume that that inventory would be sold, and because it would have been sold, we need to recognize the deferral of the gain of the inventory that the parent sold to the subsidiary with the consolidated entry star G. That's this one, debit retained earnings, credit cost of goods sold. Okay, so we're deferring the income until that inventory is sold to a third party. Okay, we're going to make a change to that consolidation entry G. But before we do that, let's kind of step back to a few chapters ago in which we talked about this idea of equity method of accounting. And when we talk about equity method, we're talking about how do we book our investment in a subsidiary. Okay, so at the end of the day, what we're going to be talking about is an intra-entity asset transactions for inventory of a downstream. So parent sells to the sub, and the parent uses the equity method. So let's go back and talk about what the equity, let's refresh your brains on what the equity method is. The equity method is when I initially purchase the subsidiary is going to have their own books, the parents are going to have their own books. But the parent has to include their investment in the subsidiary. So what we do is we debit investment in subsidiary and credit cash. We pay the old owners cash, and we're just going to simply book investment in subsidiary on the parent's books. That's it. Okay? And then what happens? Well, obviously that subsidiary is going to pay us a dividend. When they pay us a dividend, we're going to debit dividends receivable, and then we're going to decrease the investment in subsidiary. So by decreasing the investment in subsidiary, we're kind of getting our money back from that dividend. Now, the equity method also says that we're going to accrue income when it's earned, not when it's received. So if the subsidiary earns $1 million, we're going to increase our investment in subsidiary by that accrual of $1 million. They may only give us a dividend of $100,000, but we're going to book $1 million of income as a debit to investment in subsidiary, credit, equity, and subsidiary earnings. Okay, so that's the refresher. When we do equity method of accounting for a subsidiary, all we do is we book debit investment in subsidiary, credit cash. We decrease the investment in subsidiary when we receive a dividend. We increase the investment in subsidiary when there is income accrual. They have net profits. Or we would flop these if they had losses. So if they had losses, we would credit investment in subsidiary, debit, equity, and subsidiaries earnings. But let's assume that we're getting a net income. Now, that's the equity method. What we do after that is we need to eliminate the investment in subsidiary when we consolidate. So if we go back a few chapters again, if you remember, we had a consolidation worksheet. We have on one column, we have the parent. On another column, we have the subsidiary, and then on that worksheet, typically we just add across, okay? Well, we can't add the investment subsidiary over, because if we did that, we'll also add revenues and expenses of both the parent and sub, so we really have the subsidiary's income twice. Once here, because we're doing income accrual, and the second time when we add across that worksheet. So what do? If you remember, we do consolidated entry I. Consolidated entry I, we would reverse or eliminate the income accrual that is done on their books. So this is done on the parent's books. This is done on the worksheet, the consolidation worksheet. It's only fake journal entries. It's not actually done to the books of the parent or the sub. But we do consolidation entry I, where we eliminate the income accrual so we can add the subsidiaries' underlying revenues and expenses. So we eliminate this income accrual on the consolidated worksheet, so that all we do is just add revenues of the parent, revenues of the sub, and we get our total revenues for the consolidated financial statements. Expenses, same thing. The subsidiary, the parent's going to have expenses, the subsidiary is going to have expenses. We add them across and we get consolidated expenses. So we're going to eliminate this using this. Now our problem is, if we do it over here, we can't debit retained earnings because the income of the subsidiary is not in retained earnings, it's in investment in subsidiary. Okay? So the one change that we're going to make is we're going to debit investment in subsidiary, credit cost of goods sold. So if you notice, we have the same entry here, except we're changing to investment in subsidiary. Now, to give you the long of short of why we're debiting investment in subsidiary, really what it comes down to is, if we go back to consolidation entry G, we would have debited cost of goods sold, credit inventory. That's what we would do in consolidation entry G. Consolidation entry G is the deferral of the income that the parent would have received if they had sold their inventory to a third party. Instead, they sold it to a sub, and because they sold it to a sub, they have to defer the gain. That's what we make in year one. In year two, the following year, we would do this, reverse that deferral, give them the gain for the third party purchase, selling of that inventory. Okay? But if we think logically, what happens is because we're debiting cost of goods sold with a consolidation entry G, it's an expense, it will lower profit. If it lowers profit, it will lower this investment in subsidiaries. So when we do this original book, we're going to lower this, okay? And because we're going to lower this, when we do this, we don't lower this. This is actually at full value. So what happens is notice we have a credit of investment subsidiary and a debit here. So let's use some numbers so that you get it. Let's assume that this deferral is for $100. Okay, so we're going to defer for $100. So let's say totally the investment in subsidiary would have been $900. Okay, it would have been $900 because it would have been $1,000, 900 plus 100, but we've got to defer that. The problem is when we do consolidation entry I, we do this investment for subsidiary for the full amount. Okay? But that $1,000 also included $100 of intra-entity transactions that shouldn't have been booked. So when we do this assuming that this would not be included. Well, if we just do our T accounts here, we notice that in investment in subsidiary we would have had 900 here, 1,000 here. We're still not closing this investment in subsidiary because we have a credit balance of $100. And because we have a credit balance of $100, over here, when we then reverse the deferral of the gain, okay, and actually take the gain, we would debit investment in subsidiary. If we debited for that $100 gain that we deferred, we now get 0, and that's what we want. We want investment in subsidiary to be 0. So that's the long answer to the short answer. In the instance in which we have a downstream, so parent to sub, and the parent uses the equity method, we're going to switch this retained earnings to investment in subsidiary. By switching it, we kind of true up the investment in subsidiary account to 0, and we kind of get to the point where we need to recognize that gain. So we're recognizing that gain by debiting investment in subsidiary. Now again, the reason why we're crediting cost of goods sold is we're bringing cost of goods sold down artificially, okay, which then will bring our profits up. And again, if our objective was to defer the gains and then recognize the gains in year 2, if we decrease the cost of goods sold, we effectively increase net profit, so now we're recognizing the gain in year 2 when we're supposed to. Okay, so that's the long and short of it. Hopefully you kind of got an understanding of why we're doing this change here. If not, rewind the tape and roll it all over.